Hello, this is Patrick. Welcome to Chart Built Wealth, Profitable Investing with Technical Analysis. Well, I wanted to go over my current buy recommendations, and I really want to stress the kind of generational moves in some of these classes. They've been, uh, you know, especially in the commodity case, as I've talked about before, some of the moves in metals haven't been seen since the 70s. And I don't think it's over, but I do think there's other parts of the commodity sector that are going to do well, uh, emphasizing energy, both natural gas and crude oil. So with that, let's get into it. So the first buy recommendation I wanted to go over is the iShares Commodity Index, the symbol GSG. And as I've talked about over since we went long on this back in August, that this is a consolidation that began back in 2022 after a huge up move in this index and in energy. Um, this has traded sideways and it's formed a big consolidation. And what consolidations do, the reason why I like to buy these breakouts is because your risk is minimal and your potential gain is really high. In this case, it's 35% upside. Maybe it's 30 now since it's up a little bit from where we went long. But this is exactly how gold and silver looked a couple years ago. And nobody was really big on the metals, and now everybody's chasing it, including central banks. I think that this index, which is driven by energy, it has a lesser metal count. I'm going to show you the weightings on that. The baton is going to get passed off here from metals to energy and to agricultural commodities and things that haven't participated yet. So again, this pattern, if you measure the base of this pattern and project it upwards, you come up with a 30.84 target, which is, I don't know, 32% higher than where we're at. And our stop is at 21.5. So the reward to risk is really favorable now. Whether it's solar stocks or it's uh, uh, rare earth metals, other things that I've recommended on breakouts like this is the time to load up because once they're up 20%, you have a lot more downside risk. So again, I'm emphasizing this as a very strong buy recommendation. Here's the weightings. So you got 70% in energy, crude oil and natural gas. Natural gas is already on a roll. Crude oil is starting to perk up. And so we have 16% of this index in agricultural commodities, 7 in industrial metals, copper just starting an up move again. Livestock, I'm not a big bull on or bear on that. I really don't have a handle on it. And precious metals, only 3% of this index is in gold and silver. So it's really got to be driven by energy. But I like the diversification of this. And I also like the overall blend of this, which makes the chart that we just viewed much more attractive from a reward to risk scenario than going bullish on crude oil. But I do think we've seen a bottom in crude oil and we're going into the strong seasonality part of oil. Yes, I got it here. So, from July into early December, you don't really want to own crude oil. And again, this is just tendencies. It doesn't mean it has to follow this script exactly, but you do like this when it's in the corner, in your corner, on what you're bullish or bearish on. So this should be bottoming right about now, and then we see an up move all the way into early July. So all that bodes well for GSG. On the piggybacking off that and bullish outlook for crude oil, I've been bullish on Chevron, and it hasn't paid any dividends yet. But this chart looks awfully familiar, doesn't it, to GSG, the overall commodity index? And this too, after a huge up move back, that probably started in 2018 to 2022. It's gone sideways for 3 or 4 years, and the bigger the base, the bigger the pattern. Normally, the more explosive it is once it breaks out. So this has a 212 price projection on it, and we're at 150. So the potential upside is around 30%, maybe a little bit, maybe 35%. So, and your stop is right here. So if this breaks 45 for sure, I would be out of this with a small loss. And if I'm right and this really takes off, the gain could be very, very huge. Some of the other uh, oil companies like Exxon, like I'm trying to think what else, namely Exxon and some of the indexes, XOP, which is has a heavy weighting towards drillers. Those have already been on a roll. So Chevron has lagged, but what usually happens is this group goes together, and also once you do break out from something like this, it's could be pretty explosive. I'm hoping that's the case. So bullish on Chevron. That's the second buy recommendation. I want to talk about the long bond treasury yields. My call here is to short treasuries and to bet that interest rates on the long end of the curve are going to go up, the 20 and 30-year bonds. So most people, let's say novices who don't really know the difference in the yield curve, et cetera, they're saying, well, the Fed's going to cut the rates a lot, new Fed secretary and coming in soon, and they're going to aggressively cut rates, and so yields are going to go down. But you think about that, if the Fed controls short-term rates, so they're going to cut the short-term interest rate, and so yeah, maybe short-term rates go down a little bit, even though they've kind of anticipated that and already had a big move. But what does lowering short-term rates do? It causes inflation. It causes the long end of the curve to go up because of inflationary expectations. It causes commodities to go up faster. There's a lot of rational ways to rationalize a cut in interest rates, short-term rates, helping a lot of these recommendations. And I really don't focus on it. So many times people want to rationalize everything in the market, and the basis of technical analysis is that the markets are not rational. They're driven by human emotion. So, if you this chart on yields historically on the 30-year bond, if you go back to 1980, this has been in a decline within this channel all the way back then. So that's what spurred the great bull market, was lower and lower interest rates, long interest rates. But you can see something happened in 2020. Of course, this was COVID, but it doesn't really make a lot of sense. COVID slowed the economy, and we got this explosive move in the long treasury bond, the 30-year treasury yield, meaning that rates started to go up rapidly. And then since 2020, the middle of 2023, they started going sideways, which happens after you have a big move like this and you get overbought on your relative strength index. By the way, we had a negative divergence on that higher high. Uh, this is showing a sign of strength, though, that it's going sideways and not correcting down. So I don't think the move in interest rates up is done at all. I think it could go up in a really meaningful way and be one of the most profitable trades of 2026. So I wanted to show you the treasury yield, the long treasury yield. And as the Fed cuts short-term rates, expect this to go higher because it will be inflationary. Now I'm going to show you the security that I'm using to uh, increase in value as rates go higher. And this is it. The TBF is the symbol, and it's shorting the 20-year Treasury. And so here, just in late October, we started to see a rise in this, meaning that Treasury bonds started to go down in value. If you remember back 6, 7 months ago, I was bullish on this. I was bullish on TLT, which is the opposite of TBF, and now I'm on the other side and expecting rates to go a lot higher, and this will appreciate as yields go higher. So if you have a mortgage, if you have revolving debt, if you have anything like that, besides just wanting a good investment, this is a nice thing to have. As your mortgage rate increases, uh, this will go up in value and help offset that inflation at the stores, all those things. This is something that, it sounds exotic, but I've done it before, and I think it was 2000 and was it 14? No, I'm sorry, 1994 when the stock market was down 20% plus, and treasuries were down 20% plus. So if you had a balanced portfolio of 60% stocks, 40% bonds, you really got hammered because there was no diversification there. So anyway, this is a small inverse head and shoulders, bullish inverse head and shoulders pattern here. Shoulder, head, right shoulder, neckline. And we broke out of that last week. This is sort of projecting a 4% move on a very short-term pattern, but you saw that bigger triangle that I was showing you. I think I got it on the next page here. Let me show you what I'm talking about here. Here, this triangle has been going on for a couple years. If this goes up 4%, that'd bring it up to 25. And this is that triangle that I showed you on the first chart on bond yields. So here we are. That would take you right up to the resistance line, and then we'll have to see what happens. So again, I'm very bullish on shorting U.S. Treasuries. Last but not least, another under the radar screen, but also in with our commodity theme here, and that is corn. And so, how exciting, right? You hear look at all these YouTubes about the farmers saying how they're gonna, you know, shoot Trump because of, all the tariffs and what it's doing to the grains out there. And usually, again, a market technician looks at sentiment, and when you get sentiment at a really, really low level, it's one tool that we look at. It tells you that everybody is capitulated and thrown in the towel and saying corn will never go up, and so that's one thing that I think is in favor of corn going up. But the other thing is the Elliott wave theory, which you guys have heard me talk about, and there's a clear five-wave pattern up here into the top of the first wave, and once you see a five-wave pattern, you know the trend is up. And then here we got a three-wave retracement with a lot of overlapping wave action. And I believe that we've seen the bottom of wave two. So what's exciting about this is that it'll be exciting if it goes up, is that we're entering a third wave of a, and third waves are the most profitable. They move the fastest. We're in a third wave in silver and gold right now. I'm trying to think what else I've recommended that we're in a third wave, because I search out third waves because again, they move really fast and they're very profitable. So that on a short-term basis, we have a nice little bullish channel here going. And here's where I went long. Again, we haven't really profited really at all here, maybe a tiny bit. But I am expecting this to really get going on the upside. And here's the seasonality on corn. You couldn't be in a better spot. So you got all December of this thing going vertical, and then you have a little bit of consolidation in early January, and then it's off to the races again. So with corn, you want to own it from October until June, and then you don't want to own it for a while. Again, this is just a tendency, but it's certainly a decision maker, especially in the grain markets. So thank you for watching Chart Built Wealth, Profitable Investing with Technical Analysis. Please like and subscribe. Tell your friends, neighbors, and family, and go Bears. Have a great Sunday.